Welcome to the Building and Growing podcast. We're delighted to be doing our first panel podcast today with three fantastic guests. So welcome to William Folks from Flock Cover, Nyasha Kawana from FloodFlash, and Mark Robinson from Superscript. Welcome, everybody.
Morning.
Fantastic. Well, look, let's kick off with introductions to yourselves and the firms that you work for. I'm going to go in, what is my clockwise direction and start off with Will.
Hey, I'm Will. So I'm our head of pricing and data science at Flock. So Flock, we are a motor insurance MGA. We offer a connected insurance product. So what we do is we work with fleets who have telematics devices connected to their vehicles. We work with them how to utilize that data and how to help make them safer and reduce crashes and make those crashes less impactful.
Fantastic.
And my particular role, so I'm an actuary, so I'm a statistician. I work with our mathematical models and I help use all of this data that we get in to build models that our customers can use. And we work with them, we talk with them, and we help them understand the maths that we do, the data that we have, and how they can use this to crash less and to crash less badly when unfortunately they do.
Fantastic. I love how you summarize that there in terms of, we're helping customers to crash less. And, I think telematics is a super interesting data point that, we'll dive into later on in the podcast. Thank you, Will, and welcome. I'll hand over to Nyasha next.
So I'm Nyasha. I ended up at FloodFlash a little bit over 4 years ago, I guess because it married two of my interests, both of which I discovered when I lived in Japan after university. The first one, insurance itself. I discovered insurance in Japan and fell in love with social purpose. But the other thing I developed a rather morbid fascination with was natural catastrophe. So everything from typhoons to tsunamis and earthquakes, which that little island, not so little, but that island suffers, if you like, significantly from versus this island. That's part of my fascination. So at FloodFlash, we consider ourselves a catastrophe players, so related to my morbid fascination. And today, the product we have on the shelf is Flood. What we do is parametric insurance. So essentially, you define a parameter or condition for the event you want to insure against. And if that condition is met, you pay out a pre-agreed amount. The example I use, the simplest one, is life insurance. That works like a parametric product. If the event is met, which is death, in the simplest use case, a pre-agreed amount is paid out. And there's no discussion really about, how dead you are or the value of your future earnings. It works simply like that. So in our case with flood, the event is essentially depth of flood water, and when that depth is met, or depths, you can choose many conditions, the pre-agreed amount or amounts are immediately paid out to you. One of the USPs, if you like, of parametric insurance is that you're able to pay claims quite quickly. Our personal best from last year, November, is 3 hours, 50 minutes. And that's from that event being met, floodwaters reaching that pre-agreed depth, to us authorizing payment on our platform.
Fantastic. And look, I doubt any of the audience members will have had an insurance claim paid out faster than that. So, and especially for something as complex as a catastrophe. So looking forward to diving into that in more detail. And I guess, pardon the pun, diving into the flood. But,
Their loads will be inundated later. There'll be loads of puns. Don't worry.
Excellent. Thank you, Nyasha. And Mark, would you like to introduce yourself?
Yeah, of course. Morning, everyone. My name is Mark Robinson. I'm the EU and UK solutions lead at Superscript. So Superscript are an insurtech, and we work with businesses from startups to scale-ups, from micro to multinational, and we help them obtain the insurance that they need and make sure that insurance grows with them. We are the first insurtech registered at Lloyd's of London, and we truly try and digitise the insurance process. So we allow our clients to purchase and manage their insurance policies online, and they can do that within a matter of minutes. On top of that, we also have a advisory and broking service which helps clients with more complex exposures, more complex risks, obtain larger insurance policies from the wider insurance market.
Fantastic. Thank you so much, Mark. So just for the audience's benefit, today we're going to be going into three main topics, the first of which is the emergence of data-driven practices in the insurtech industry. We'll then dive into what other sort of subsectors within the insurance industry are ripe for disruption before closing off with what challenges the insurtech industry faces. So we hope that, either you stay with us for the whole podcast or you skip to the part that, you're most interested in. So without further ado, let's dive into what led to the emergence of data-driven practices. Now, I know during our pre-call, we had started off with Mark having a response. So what I might do is sort of follow that same sequence of Mark, then Nyasha, then Will for this initial question. So Mark, do you want to kick off with your views on that?
Absolutely, yeah. So I think customers nowadays have a certain expectation of having a more digital journey and a more digital experience. The insurance sector is so far behind that. So it's still very heavily paper driven, still relying on legacy systems, and it just doesn't lend itself to giving customers that digital journey that they want. What that has done has opened up opportunities for insurtechs to change the face of that. So I'll lean on Superscript, obviously, because that's where I'm from, and that's what I'm going to do for the rest of the morning. So we have an internal data science team. So those guys build systems. Those guys work with the data that we get in to make sure that customer journey can be truly digital. And I must say this 4, 5, 6 times a day. Insurance is a necessary evil. It's at the bottom of everyone's list of what they want to do, but it has to be done. The easier we can make that journey, the easier we can make the purchase and the whole experience, then the better that experience and journey those customers are going to have. So that is our sort of journey and the reason we got involved in insurtech, and I think that's why we're seeing the emergence of more more insurtechs around now.
Fantastic. And look, I mean, I think you've given a really good example there of the fact that the customer journey wasn't, or the user experience wasn't always fantastic, and that's particularly true for SMEs and individuals. FloodFlash, I guess, is looking at SMEs and larger businesses, I would say. Are you able to talk a little bit, Nyasha, about sort of your view of how that's how that data-driven change has occurred?
Yeah, so I think what Mark has said is right. Customers are probably pushing the change in insurance. I'll also add that as well as the insurtechs, the incumbents are wanting change. Mm-hmm. Maybe not pushing as much as they ought to be, but they're wanting it. A lot of the founders of insurtechs have come from, if you like, the incumbents and have seen that something isn't working, and they're obviously founders that come from outside the industry and have observed that something isn't working. One of the things that isn't working, and this is where FloodFlash plays a role, is that you have many individuals and businesses that aren't offered the financial protection that insurance can offer. So if we take flood losses globally, they're estimated at around $70 billion per annum.
Wow.
80% of those are not covered by insurance companies.
Wow. So
that leaves a vast opportunity for the insurance industry, namely, to come in and play a role. And why do they want to play a role? I want to say many, like me, believe in the social purpose of insurance, so they think we should find a way. But for others, it could just be business, right? There's an opportunity, let's fill it. And if they can find a way to build a sustainable business, they will, and data is often the answer to it. So parametric insurance, which I talked about at the beginning, has existed actually in concept for a long time, since ancient Rome, but it's only now growing or expanding thanks to the availability of data.
Yes.
And that data is because of advances in technology. So it means in the first place you can measure it and build incredible data sets through, it could be like satellite data or Internet of Things. Like we have a proprietary sensor that allows us to do that. And that in turn enables you to understand risk better, to price risk better, and in our case, eventually to pay those claims. So not only is it more available, but the ability as well to process that data, because you have, if you want, sheets and sheets, if you want a visual imagery of sheets and sheets of data that needs processing. Technology allows you to do that. That's why now there's really an opportunity for parametric insurance as a concept that's existed before, but it's really technology that's firing it, and it's enabling us to insure those who haven't been insured before, and to protect the previously uninsurable.
Yeah, that's fantastic, particularly given, 80% of, some of those, 80% of the, I think, $70 billion market you mentioned was uninsurable. It sounds like data has led to, the emergence of a new product that can help insure that. So it's fantastic. And Will, data, as you touched upon earlier, really, falls into sort of Flock's, pricing. Are you able to talk a little bit about your view on it?
Yeah, very much. Actually, one of the last points you were making was on the actual ability to use it. As one of the standard things that will be discussed is, yes, data is becoming more available. But one of the things that isn't discussed enough is what goes on behind the scenes of, well, this data's here, but can you actually use it? Can you store it? Can you process it? Can you actually get this into something which is helpful? As I started my career in an incumbent insurer, large multinationals, and I would be working and I would be in their pricing teams. The most common data storage format 10, 15 years ago was an Excel spreadsheet. That just doesn't cut it anymore. And the technology of storing and processing data, if you're thinking, as you're saying, sheets and sheets of data, we're talking terabytes of data nowadays, and sometimes terabytes a day. This is like an unprecedented amount that you're trying to get into a modeling process, and the technology it's there and it's keeping up, but it wasn't there 15 years ago to be able to do what we need to do today, and the modeling techniques weren't there because they hadn't needed to be designed. So what you really have is kind of two things constantly trying to keep up with each other, which is all of these really cool and exciting new data sources coming. So for Flock, our main USB data source is this telematics data coming in.
Yes.
You have a vehicle every second, you have every information you have about it. You have where it is, you have its speed, you have crash files, you know whether it's harsh braking. You have a lot of really exciting information. But across thousands and thousands of vehicles, all of this information every single second. You're trying to get all this, you're trying to store all this, you're trying to process all of this. You couldn't do that 15 years ago.
Yeah.
And yeah, we're at a really exciting time where that's properly coming through and they're all, say, merging at the same point. So yeah, that's one of the things that's really helped push it forward of, honestly, we can now.
Yes.
And it's really cool and it's really exciting.
Indeed, yeah. Look, and I think that brings me back to one of the points we discussed on the pre-call. I think Nyasha had mentioned that if the pandemic had have happened 10 years earlier, the data infrastructure wouldn't have been there to sort of help support, with the recovery.
I honestly couldn't agree more with that statement. It's one of those, I'm attempting not to use the word lucky timing things, but you know exactly what I mean of, if that happened, say, 20 years ago.
Yeah.
How do you actually still run your businesses as we managed to do over the years where we, couldn't be in the office, where if you have to run everything, say, on your laptop and everyone's laptops are sitting at home on their desk, I cannot run my work on my laptop. I have to use cloud compute, which is now in an exciting, it's now the norm, which in itself is fantastic. But 20 years ago, if I had to run everything at home on my laptop, and I have a very nice laptop, it doesn't cut it though.
Yeah.
So yeah, it's I couldn't agree more than Yasha's point. Like, that timing was, I'd say, just late enough. You managed to get through it and keep going.
It fast forwarded us, didn't it, by about 10 years maybe. And it's coming back to a point you mentioned earlier. I think is really interesting when you mentioned that the incumbent, the sort of global brokers you'd worked for previously stored everything in Excel spreadsheets, and they had all these reams of data. That still happens, by the way. So businesses I've recently worked with, insurance brokers I've recently worked with, and insurers. Excel spreadsheets are still the go-to model of collecting and storing data. And again, worked with businesses where we have reams and reams and reams of data, all this data. What do we do with the data? And that's the issue. It's great. We see businesses collecting data, and we need more data. We need more data. But actually, there's no systems to do anything with it. There's no systems to model that data. And again, that's coming to the very the sort of point of the legacy systems that a lot of sort of the insurance market, the insurance sector still run. They're just not designed to model and hold that amount of data in any way that's useful, in my opinion, that I've seen.
I'd agree. Like when I joined Flock a few years ago now, having worked at a consultancy, so going around, and we were looking to implement pricing models. And there was often the conversation, which is, okay, so what are our biggest competitors out there? It's Excel. It's definitely Excel. It's your biggest competitor as anyone. And I came to Flock, and the first thing I asked was, just out of interest, show me your systems. As in, if I give you a policy, what information can I just get quite quickly? Everything. Because it was built from scratch, and it isn't 7 legacy systems all blended together in ways nobody quite understands. It's one system, built ground up for purpose. So yeah, the ability to build from a point of flat and go up, it's refreshing, to be honest.
I just wanted to add a caveat around this COVID insight. I did read it. It isn't a bit of insight I don't know, I plucked out of my own knowledge. I did read about it. But even I think one of the things we're talking about is the ability for all of us to be at home on Wi-Fi at the same time.
Yeah.
Everything would have crashed back then. But again, all the network providers have improved, if you like, the ability for all of us to stream movies all at the same time, because there is so much data there that's being transferred left, right and centre, and much more processing of it. But for sure, 10 years ago, it would have been just impossible to run a Zoom call during COVID.
Indeed. Yeah, and I'm not sure that WebEx would have survived as well, back in the day. But look, fantastic. So I guess, in terms of data, we've discussed FloodFlash, having the data help to insure the previously uninsurable by creating, a new product, as well as, using data, let's say from the flood sensors to pay out, straight away or within hours as opposed to weeks or months. Will, you've talked about how Flock offers, let's say, data-driven pricing based upon the telematics. Mark, I'm just wondering whether we could dive into maybe how Superscript use data for distribution.
So one of the big things we do is, again, going back to that, the fact that insurance is kind of the necessary evil side of things. And if we're dealing with business from a startup process, what we tend to find is that a founder of a startup business will come in and they'll put some type of insurance in place, and it'll cover the absolute minimum requirements usually, whether it's because they've signed a contract that says you must hold this insurance or whatever, or they're just prudent and want to have insurance. But whatever it may be, they will find the minimum cover they need, and that's absolutely fine. It might be a one-person startup. As the business scales and grows and they get more employees in and they fundraise and they become regulated or whatever, it's a condition of the insurance policy that the customer, that the client, update the broker on these changes. Otherwise, the policy is no longer fit for purpose. Now, as the business grows, the level of interest in the insurance tends to drop to get right to the bottom of the list. So if a business was to fundraise or if a business was to become regulated, the last person they're going to tell is the insurance broker. Okay, so we still see it now with businesses that have been in operation for 5, 6, 7 years and have gone from being a pre-revenue business to a multi-million-pound business. They've raised a couple of rounds. They're over in the US doing loads of cool contracts and this, that, and the other, and they've still got a £200 office package policy they bought 5 years ago. And it's just because it hasn't resonated with them. It's not on the list of things to do. And we sort of thought, what if we can preempt that? And what if we can have triggers that if a business hits a certain turnover level or if a business becomes regulated, we are aware of that. And we can preempt that and speak to our clients and say, well, hey, you bought this policy from us. It was great at the time, but actually now you're a bit bigger. So we call it a graduation process. And that is on data points that we collect with our clients. So what will the process will tend to be that a client will go, a startup may go online and purchase an insurance package from one of our online processes. They will have that insurance for a year or two, and then it will trigger. So there's two sides of our business going back. There's non-advised and advised. So the advised side is akin to the broking side for more complex risks. We will see that non-advised clients will get to a stage where it will trigger one of the systems that we have in advised, and one of our advised team members will see that, and they'll contact them and say, hey, look, you've got this policy. We've seen that you've just raised, or we've seen you've become regulated. We now need to have an actual discussion around what your actual risk requirements are and what the exposures are actually going to be. And we're going to have to move that from that policy to this policy. Doesn't always work, because at the end of the day, we're asking them to pay more money. But it's trying to make that process easier for the client. And if we go back to that being a necessary evil of buying, it's okay. We know what process you are in the scaling game. We can make sure that the policy that you buy grows with you as a business. So it's a truly sort of scaling insurance policy, if you like. And not only does that sort of help with the journey, but I mean, insurance is an expensive piece of paper until something goes wrong and you need to claim. Yeah. So it's making sure that if you do need to claim, then the piece of paper that you've bought, which is generally quite expensive, is going to actually do something for you. So they're the sort of data points that we use and model to make sure that our clients have always got the right cover in place, regardless of the stage of their journey.
Fantastic. And look, I guess I've got one quick final sort of data-driven question for Will before we go into the disruption area. Will, I guess Mark's spoken about how policies can graduate based upon data points. When it comes to the telematics data, is there any incentive for, say, the fleets that you insure to improve their driving? The reason that I'm asking this to Will as opposed to Nyasha is because I guess the businesses don't have the ability to control catastrophes and flooding, whereas they can control their driver behaviour.
They can mitigate the actual losses, though.
Okay.
For example, they can put in flood defences. And if they were to do that, let's just use the simple example for floodgate at 60 centimetres. If they were to do that, it means they can choose higher trigger depths, which generally correlates with lower premiums, if you like. Because the higher, if you like, the flood, you anticipate, the lower the probability of that flood actually ever occurring in the first place. So there are ways to mitigate. But no, we haven't developed a way to stop flooding. Yes,
yeah, that's it. I mean, I'm sure the businesses would love to if they could.
We would love to. We would be done.
Yeah. But I mean, you guys are working with fleets, with drivers who are out there every day. Do they have an incentive?
They do, yes. So we offer a product which we call a rebates-based product, where you are charged a normal amount like an insurance contract. However, based on your safety, and we measure your safety from your telematics data, your driving behavior, based on that, we will give you a rebate at the end of the year. So if you are a safe fleet, you'll get a rebate. You'll get money back, essentially. So we provide a direct financial incentive to be safe and to improve your safety. And this is one where, talking of kind of graduation, let's say, and looking at small and big fleets and how we will work with these potentially differently. If we have a large fleet, or even a medium fleet, to be honest, we will work with these fleets and we will provide what we call interventions, where we will go out to the fleet, we will discuss with them, okay, we have enough data on your fleet that we can profile your driving behaviors, we can actually see what are your core underlying causes of risk. So without us, you may well get safer, you may well not. However, if you work with us, we can help you improve the safety score. We can help you get safer, help you crash less. And obviously, making people crash less, even outside of a financial incentive, that's a thing everybody wants to do.
Indeed.
And, like Flock's mission statement is to make the world quantifiably safer. But for the fleet, even outside of any of those benefits, it's just pure financial. As in, you will get money back from your insurance policy, your cars will be off the road less, and we work with couriers. And if your car's off the road less, there's more revenue coming because that is your revenue stream. Indeed. So they have multiple financial incentives, as well as just the standard incentive of everybody wants to crash less to actually get safer.
Fantastic. That's great. Well, look, I think the three of you have provided, some really good examples of how, the firms that you're working for are disrupting the industry, and how, these data-driven firms have emerged. I'm going to dive now into our second theme, which is, subsectors within the insurance industry that are ripe for disruption. Now, I'm going to start off here with Nyasha, because I love the statistic you provided at the beginning of the podcast about the fact that, FloodFlash has gone after an industry that was previously 80% uninsurable. So where do you see other, let's say, sectors that are ripe for disruption within the insurance industry?
Broadly, I want to say anywhere where you have a population or a peril, perhaps specifically, that isn't easy to insure. So we've talked about flood risk as an example, but all other catastrophes like quake and even wildfire sort of sit in the same bucket.
Yes.
Parametric insurance for sure has a role to play. It's clearly what we do, but even within traditional insurance, I think you can exploit data to understand risk better. That's primarily what insurance companies want. They want to understand what they're underwriting, and if they do understand it, then you can price it, as it were, and manage that. But specifically within parametric insurance, if you can meaningfully connect risk with a data set, you can employ parametric insurance. So it's for our mission anyways to roll out parametric insurance into the other catastrophe categories. Outside of catastrophe and even parametric, I have an interest too in emerging markets. You have, large and growing populations that also remain uninsured today. Are they uninsurable? I don't know. But I think you still have the same challenges often of having data or data that allows you to understand the risk specifically. Even just small examples, the reason it's quite easy to price a house in the UK is because every unit in the UK is on a database somewhere. And this is a government-held database,
yes,
or even an insurer database. You can find it even on Google Maps, and you can find all this other data about that house. How far it is from the high street, how far it is from the fire station, if any other homes on that same street have had burglaries, for example. You find all this data that allows you to understand, the likelihood of, I'm focusing on a couple of risks, but the likelihood of a burglary, and even the cost of an eventual burglary, right? Because you see all the other burglaries were, £200 burglaries or £200,000 burglaries.
Yes.
And similarly with the fire, if it's going to take the fire engine 5 minutes to arrive, that's different versus 35 minutes to arrive in terms of potential losses. So you already have an awful lot of data. But if you're looking at some jurisdictions, in some parts of the world, they don't even have addresses. So how do you even locate the property?
Yes.
And then where do you get the data from to understand a whole host of things about that risk? But again, I talked about satellites earlier. They allow you, in a sense like Google, they allow you to have a view of that risk that you didn't even have before.
Yes.
Because in the UK, we were pricing homes before we had Google Maps, for example. You didn't have to have eyes on it. But now at least you can have eyes on it, and you can understand its size, its construction, proximity to other homes. That might then mean it catches fire more quickly if that's what you're concerned about. And I think data will mean you can go into those spaces. I just used that example, but there are many other classes of insurance that are maybe even more urgent than property insurance in emerging markets, where you can now go in and understand the risk a bit better and provide insurance.
Yeah, fantastic. And look, I mean, I love emerging markets as well. And, we've discussed that a couple of times, but it's interesting to see that some of the super apps in the emerging markets, thinking about like Gojek, Grab, Alipay, they've been able to create new insurance products in those markets because they have the, I don't want to say best data, but they have very different data sets than what were previously available. But Mark, what are your views on opportunities for disruption?
Yeah, very, very similar. So I think, personally, I think the personal lines market is becoming a little saturated for the insurtech space. I still think and I think I mentioned it on my last podcast I did, I think there's still a massive opportunity in the general commercial insurance space.
Yeah.
On top of that, I think, again, we talk about emerging markets, emerging sectors. There's a huge opportunity in emerging sectors there's a huge opportunity in any sector where insurers don't yet have the historical loss data or the full data to fully understand what the risk exposure is, and therefore they tend to shy away from that. So I think there are some huge opportunities, and that's kind of what we've seen and what we've tried to capitalize on. So with some emerging sectors, so we've now got our own fintech team, we've got our own digital assets team, we have our own medtech team, and a large part of what the guys in those teams do, aside from obviously speaking with the market and trying to get business in, is working with the underwriters to try and educate them and get them to understand that actually this risk exposure that you think may have been up here actually is down here. And again, the insurance market is as such that nobody wants to be the first person to put their head above the parapet and say, yeah, okay, I wrote this risk that's had a massive loss and nobody else has written it before, because the question's going to be, well, why did you write it? Like, there was no data behind to tell you why to write it and what to charge it at.
Yes.
So I think Insurtechs, working in collaboration with the underwriters, with the insurers, can start building on that massive opportunity for those sort of emerging technologies, emerging sectors to drive forward in those industries, I think.
Yes, fantastic. And look, I mean, I think the historical loss data, it's a very interesting data set which doesn't get a lot of airtime, let's say. But Will, I guess as an actuary, you would love, data and having more data for your models. What's your view on this?
The historical loss data is actually a really interesting point. So just leaning into fleet insurance, because that's what Flock are interested in at the moment. So it is, whenever you look at historical loss data, to be clear, yes, I would always like more historical loss data, 100% of the time. What you end up with is, though, a really interesting question of, this vehicle has crashed. Was it luck, or was it actually an underlying behavior? Of, if you have a small amount of data, it is very difficult to tell, because you do sometimes just get unlucky. That is the nature of, life, to be honest. The more and more historical data you have, the more you can filter out what was luck and what is actually due to an underlying behavior. And this is where kind of getting a better understanding of your exposure, as we were talking about just now, really helps, because if you have some historical loss data and you can combine that with some actual kind of underlying driver behavior in this example, you can look and go, well, yes, they've been crashing a lot, and also they're driving really poorly. This all stacks up. Or the other way around, which is a really interesting opportunity to where you look and go, well, the history shows they've had 3 really big claims in the last year, but we can see they're perfectly good at driving, they don't speed, they drive very safely, and oh, here are those event files, those 3 crashes. There was nothing they could have possibly done. And the goal of pricing is to say, well, I want to see what happened next year. And historical data, you want to use it to predict what happened next year. But when I'm writing an insurance policy for next year, I don't actually really care what happened 2-3 years ago, because that's not on the cover I'm writing. I'm using that to figure out what's going to happen next year. And if I can look at it and say, the fact that this crash happened 3 years ago, completely unrelated to what happened next year, it was just bad luck. These things happen, great. And we can do exactly what was being talked about and say, okay, no one wants to write this risk because they've had 3 very large claims, but we now know those 3 large claims, they weren't indicative of having a large claim next year. Fantastic. We have a market who doesn't want you, and we want you. This is fantastic. This is exactly what we're aiming for. So yeah, I really couldn't agree more. And having some historical loss data, a better understanding of your risk exposure, honestly, as you say, as an actuary, this is kind of my perfect dream of you have a bit of both.
And that's good underwriting.
Yes, that's exactly what that is.
Looking at the data and not looking at it and thinking, well, they've had 3 losses, so no. That's looking at the data and say, well, actually, what does this data tell us? So that is good underwriting.
It is. That is one of the key things that I feel is often not talked about enough. Of you'll have kind of mathematical models that by themselves, you can't just have a model sitting in a dark room in a corner. You need to be able to have a modeling team who can get all this data, understand it, explain it, and work with the underwriters, because the underwriters are the ones who are going to be looking at the risks and finding the risks. You need to provide a tool set to help them. You need to provide information to help them, because if I, for instance, come up with a model that says, and to be clear, completely hypothetical here, every car that is striped is going to crash 4 times as much, my underwriters are going to look at me and go, that's nonsense. I'm like, okay, if I can prove it, fantastic, but you need to be able to get it in a way that is understandable, explainable, and yeah, you can get underwriters to use it in a really helpful way.
I think you do touch on 2 things, and you sort of said it earlier, that there is more and more data out there, but actually you need the ability to, I'm going to broadly call it, digest that data. So whether you're using like technology to do that, which is one thing, storing and processing, but also you need humans who can, today anyway, you need human intelligence to understand that data, make it meaningful, and then apply it to what you're doing. Otherwise, it's not really useful. Another thing you said, though, is you're trying to use data from the past to predict what's going to happen in the future. And I imagine there's an equivalent in what you do in motor and fleet. But what we do, like with flood and catastrophe in particular, we often talk about climate change. Yeah. So there is a question anyway about how much we can lean on the data in the past if, the extrapolation into the future looks quite different.
Yes. And what would you do in that situation? I mean, would you be looking at, let's say, a more concentrated data set of, say, the past few years where storms, at least from what the media says, seem to be more prevalent?
I don't know if you look at more concentrated data. I must say, at FloodFlash, I'm responsible for UK distribution and our global insurance product development, but not underwriting and pricing. So it might be a little bit out of my depth. But you're going to have to apply, I'm going to call it a little bit of human intelligence. It might be a little bit finger in the air.
Yeah.
And there's a lot of this in insurance where anyway you add 10% because you're not sure. This is the premium you add for uncertainty. So I guess broadly, this is what I'm going to say. You're going to add a little premium for uncertainty.
Excellent. And I think, as you mentioned, it's not always possible to estimate and predict everything 100%. And so, you did mention that sort of finger in the air concept. But I'm wondering what other challenges you see across the insurance or insurtech industries.
We're all insurtechs, and so I think we're, we all operate on a burning platform, if you like, and we're continuously looking forward to see where the end of the runway is. And you extend that runway by fundraising. Essentially, that's the game we're in currently. There are other ways of doing that, but broadly, that's where we are. I do think fundraising is becoming challenging. Some of those things are macroeconomic, like actually very high interest rates mean it's much more interesting to put your money, if you like, in a savings account and accrue that interest rather than take a bet. It's much more of a bet. It's much more speculative in a startup that may or may not make it.
Yes.
So that's an example. But I also think the other challenges we have around fundraising are we're coming down, I'm going to say, from a heady period where investors were happier to invest in anything and everything. And there was also a bit this mantra, don't worry about profitability now, just get in the customers, show you can grow, and then you work out later how you make the money. I think particularly in insurance, that probably wasn't the best way to operate. And where we had a few insurtechs that grew, their customer numbers, but didn't watch their loss ratio, that's left a few investors a little burnt. And so their appetite, I guess, for more insurtech broadly is a bit lower. It is a challenge. As I say, there are fewer maybe investors out there willing to invest in insurtechs, but it's also an opportunity. So what you hear some investors say is, we do now focus on loss ratio, because if you're going to scale losses, all you're doing is scaling more losses. That you're just getting more losses. So I do think the disciplined insurtechs, the ones who understand the fundamentals of insurance, will find it challenging, but will still do well. And in a way, the previous environment where it was, just about customer growth was challenging. If you weren't able to tell that story because you were focused on insurance fundamentals, you're disadvantaged. But now that the focus is on insurance fundamentals, you should win if you're doing that stuff right.
Fantastic. I think, it's a very interesting market at the moment. I know there was one insurtech which had a buyer lined up, and then that has now fallen away, which was Luco. So we'll see whether they then get acquired. But another, I suppose, key issue that we're seeing building on the, broader macro environment of less money being invested by VCs is actually VC consolidation and M&A, and some VC funds leaving the market altogether. And Mark, I guess I want to ask a question to you about this, because Superscript, has its business, and actually a lot of the businesses that you work with are VC-backed firms. So, we're seeing less funding going out. You're seeing maybe less people who are self-employed. How is that impacting on your business?
Yeah, so the funding thing is I was at Sifted a couple of weeks ago, and pretty much every conversation I had was around funding. Do you know anyone here that's funding? Is anyone here still funding? So yeah, it's a huge talking point, and no doubt about it, there is funding is a challenge. Albeit there are still opportunities for, certainly in insurtech, there are still opportunities for businesses that are run well and have looked after the book and have a good quality book. We've seen certainly a slowdown in customers moving forwards with launching products because they're waiting for the funding to come through, or they're waiting for whatever it may be. So it's starting to slow down a lot of businesses being launched. And I think on the pre-call you mentioned, has self-employed rates dropped by 20%?
Yeah, the number of self-employed have dropped by 20% since COVID.
Which is it's a huge number.
Oh, yeah.
So yeah, it's starting. Certainly, what we're seeing is starting to slow down the launch of a lot of businesses, especially in fintech, We're seeing if a fintech wants to launch a program, they're just waiting months, and the wait traditionally was always waiting for regulation, for the regulators to do their bit, and now the waiting for funding to launch has just surpassed that immensely. So yeah, it's a big slowdown.
Yeah, far out. And Will, I guess from your side, I guess two of the themes that Nyasha and Mark, a theme that Nyasha and Mark have, really talked about is that focus on, profitability and growing sustainably. What are your views on this?
I mean, pretty similar, to be honest. We were talking a bit earlier about how there was, in COVID times, a forced innovation on the market. There's a similar sort of theme of, historically, if you're looking just to grow your customer base, you're looking to, expand revenue, you're looking to make a bunch of very interesting and cool proof of concepts. Now, these are not proof of concepts. You need to be building something, getting it into production, making sure it works, making sure it's up to date, and making sure you can actually be aiming for profitability, which is, as an actuary, as a data scientist, like selfishly, I personally love. I mean, it is a challenging environment, I will definitely admit, where there's a lot more focus on the data that comes in. Actually, what is the value of the data? Because data that people get is not free. As in, there are generally costs associated with gathering some form of data, even if it's literally just storage and processing. Like, we talk about cloud computers, it's this magical service. It's a magical service that companies charge you for.
Yes.
So you do have to be able to justify the costs of your data, your storage, your everything, to be honest. And those justifications now have to be a lot stronger. They now have to be linked to less exciting 5-year runway R&D and more, okay, this is what we're doing with it. This is how it's going to impact customers. This is how it's going to be revenue generating. This is actually how it becomes profitable. And it's a very different ecosystem than it used to be. And kind of from my personal opinion, this is not a Flock opinion, this is a William opinion, it makes my personal job exciting.
Yes.
Like, it's knowing that whenever I go out, talk to a data provider, talk to anyone in the ecosystem, that I have to go, all right, how am I going to bring this all the way through? I think it's where the industry needs to go, because as we were talking about, you can't have an industry that survives by fundraising and having poor loss ratios. Like, it's not long-term sustainable. You have to be able to get to a point where actually, as an insurtech industry, we're profitable. Otherwise, it's going to keep going in the same direction, and we need a bit of a turnaround, which we are just starting.
How have you found that experience of educating the investors about loss ratios and this change and focus on profitability?
We've actually seen a bit of not a change in investors, but the sorts of investors that are still looking at the market. There's a bit of a filter, let's say. Is the investors that are still looking are generally the ones with much stronger insurance fundamentals. So it's less of a problem, in my experience, than you think it might be, because the ones who are investing, the ones who are now being on a board from a fundraising round, they will already have a strong insurance fundamentals, which, if you look back over a previous time period, it might have been more external from industry investors, let's say.
Yes.
And so it's actually less of a problem than you might think, because if someone comes in with strong fundamentals, you still need to be educating a bit on the more technicals, the specifics, but the industry understanding is more than it used to be, which is great.
Fantastic. Yeah. And I think, it always helps to have people that understand the business and the industry sitting on the board and, working through those numbers with you.
Yeah.
Yeah, I want to say in earlier rounds, at least the FloodFlash, we did choose, you're also choosing your investor, we did also choose investors that understood insurance. And loss ratio, in a sense, is a basic. It really is. When I have new team members join the team, I explain to them how the loss ratio fits into a combined operating ratio, but that's to give them a broader picture of how insurance works and eventually how we make money. So this is really a fundamental. I wouldn't say that's our challenge. I think outside of our investors, when networking, as it were. The other investors as well seem to understand this. So I think Will is right. They've been the others have been filtered out, and so you have a good crop left. And I do say loss ratios are basic because after that, there's still a task to educate your investors or prospective investors, because there are nuances in geography. We operate in the UK and the US with essentially the same product, but there are nonetheless nuances in geography, how customers behave, how distribution operates, how regulation works. And we also go in with assumptions about how things are going to work, and we learn new things. So in turn, you have to educate your investors about that. The job isn't done just because they understand loss ratios, but we do have essentially a cohort of investors, I think, today that understand insurance and have appetite for it.
Fantastic. Mark, anything you'd add?
No, similar to what's been said. So yeah, certainly the investors we work with have got a background experience in insurance, which obviously makes the whole thing a lot easier. But yeah, it's I think gone are the days where investors will just generally invest in anything as a scattergun approach. Gone are the days, sort of going back a step, gone are the days where you'll get funding off the back of an idea on paper. It now has to be a fully fledged, this is where we're going and these are the results. So yeah, I think just having investors that have an understanding of the sector you're in is going to be of huge assistance. So nothing in addition to add really to that.
Fantastic. Well, look, I think, some real key takeaways there, making sure that now you've got the kind of right investors on board that understand the industry and the sort of key KPIs. We've mentioned loss ratio, Nyasha mentioned as well, combined ratio there. That's of huge importance. We're seeing a slowdown of maybe startups or funded businesses requesting insurance. Previously, they were waiting on regulation. Now they're waiting on funding. And, just overall, there's a much bigger focus towards profitability. And, more broadly in the market, we might be seeing some insurtechs kind of going out of business if they didn't have the right, let's say loss ratios. But we're also seeing that across BC. So I think it's a much more sort of macro trend as opposed to any, huge challenge that the insurance and insurtech sectors are facing alone. I think we've covered a lot today, and it's been very, very insightful. So I want to thank each of you for joining. But before we wrap up, are there any sort of closing remarks that each of you might have, I guess, open mic style?
Oh, only to really say like a bit of a summary of what we've been talking about. It's exciting, to be honest, like having spent my career, making models based on the data I have. I think when people don't often really conceptualize the change in even just the last decade, like it's amazing. Like it really is. Like it is a fundamentally different job than it was 10 years ago. And it's wonderful. And I'm could not be happier with the change that's happening with that.
Excellent. Thank you, Will. Nyasha?
Yeah, I think I'll say the same thing. Technology is providing ample opportunity. We've talked a lot about data, but not even about the opportunity, for example, the smartphone has presented, just the ability to connect with customers. In these emerging markets I talked about before where you don't have an address, you don't have that, but your customer has a smartphone. This is like incredible. And so I can't even imagine where we'll be in 10 years. That's really where I am today. I cannot imagine it, but I'm excited.
Yes, indeed. Sometimes it's just going to happen before, we realise the opportunity that's there. But thank you for that, Nyasha and Mark.
Yeah, I can only but echo the excitement. So as a sort of 25 plus year traditional insurance broker coming into the insurtech world, it's opened my eyes. I think just sort of going back a step, one thing that I think, or a couple of things that I think insurtechs need to be wary of are time and pricing. And that comes down to an inherent link that we as funky cool insurtechs have with the traditional insurance sector. So in terms of time, regardless of how fast we innovate and how fast we do things as insurtechs, we are inherently reliant on insurers and underwriters. So we can only go as fast. We need to wait for them to catch up. So we can innovate and move as quickly as we can, but essentially we're going to be waiting for insurers to play catch up. And secondly, it's I'm being mischievous because there's an actuary in the room. But from what I see in terms of pricing, and correct me if I'm way off the mark here, I think that pricing is becoming a little bit of a commodity, in that I see underwriter A's charge that, so actually underwriter B, I've seen I'm going to charge that, and underwriter C, I'm going to charge that, and we seem to have that level there of somebody do something, and I think that had a little bit to play in the market, maybe not hardening as quick as it could have done, because I certainly saw underwriters think increasing rates, and it's like, well, we've just lost a ton of business because 90% of the market are still rating at that. So I think how we get away from that, I don't know. It was a as I say, a mischievous comment for the actuary in the room. So I think there's two potential drawbacks issues there in the insurtech space.
Fantastic.
That could be one for offline.
But if you want to respond now, feel free.
Let's take it offline.
Excellent. Well, look, thank you very much once again for taking the time today, and really looking forward to seeing how the industry evolves over the next few years.
Awesome. Thank you for having us.
Thanks, Lucas.
Thank you.